Hey guys, welcome back to another video by Fully Informed Trade, or FiTrade for short, knowledge for everyone. My name is Alex Cho, and today I am going to be talking about JP Morgan Chase and Company. Basically, it is the banking company, the one with the blue logo. You guys probably see it if you guys just drove around town once in a while, maybe. Maybe not. Maybe you guys don't have a JP Morgan and Chase where you guys live. But yeah, pretty much for all of you out there who know who JP Morgan and Chase is, well, it's more directed to you guys. JP Morgan and Chase did have a pretty negative day on the session. It did fall by around 2.5%. And again, this has to do with equity markets in general. When you see selling in equities, okay, when stocks sell off, all right, chances are bonds are going to go up in value. And right now, JP Morgan and Chase lost around 2%. It is probably going to be able to make back some of it throughout the session. But again, I'm not really that optimistic on JP Morgan and Chase going forward. The main reason is how they've set up their derivative position. As the value of the bond markets, if the value of bonds go up and if the bond markets boom and they have a nice little rally, JP Morgan and Chase does stand to lose a lot of money in that circumstance. I believe they've already had like $5.5–6 billion in derivative losses, and it could probably get worse than that. It really depends on how they structure their derivative contracts at this point, whether they decide to buy a lot of call options on the bond market to at least reduce their risk exposure. But the damage has pretty much been done. The market participants are more or less going to see a higher bond market being a huge negative for JP Morgan and Chase financially, and this is going to have a negative effect on the stock. So, whenever the stock market declines, you're going to see JP Morgan and Chase at least double or triple the declines, mainly because of how their assets, their trading division has been set up. So again, this is what I see, a breakdown of the bear flag pattern, this modest volume, but again, I honestly think over the long term it's a safe bet to assume that bonds are going to continue to be bought up. 10-year treasuries are at around 1.5% now on the U.S. Treasury market. JP Morgan and Chase did make a bad bet, as did many others. And I understand the logic behind why they did it, but at the same time, markets can be pretty volatile, and JP Morgan and Chase got caught up in its own intelligence, I guess. Anyway, take care, folks. If you guys have any questions, be sure to go ahead and leave a comment right below, and I'll try to take care of it as soon as I can.